we keep asking ourselves, does it make sense? Does what we do, does it make sense on a risk-adjusted return? And then when the answer is no, or maybe, then okay, what should we be doing? And in 2017, for example, for us, equity in New York City stopped making sense because of pricing, because of risks, because of regulation, and we started lending, and I'm very happy that we did, because it was, in hindsight, a very good decision.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Ran Eliasaf is the founder and managing partner at Northwind Group, a real estate private equity firm with $3 billion in assets under management of debt and equity investments. Ran, welcome to the show.
Thank you for having me, Sam.
Absolutely. The pleasure is mine, Ran. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
So I started just before the financial crisis in 2007. I was the right hand of a local businessman that did a lot of real estate investments. He kind of taught me the ropes. I started as his driver / secretary and kind of became his right-hand man. Unfortunately, he passed away very suddenly. And after helping his clients deal with what was left, one of them introduced me to his family office. They invited me in. I ended up launching my first fund under that family office right in the middle of 2008 in the financial crisis. We started buying distressed debt, secured mostly by grocery anchored shopping centers in the Southeast. Did that between 2008 to 2011, sold that portfolio. It was about 500 square feet, or my stake in it, I should say. And then started investing in New York, initially on development deals, then income producing value add, and then stopped buying in New York City in 2017 and started lending. And ever since, we've been lending, and that grew to be a pretty large business for us.
Wow, that's a lot of transition there. I love the starting as the driver, and now you got $3 billion in assets under management in commercial real estate. Was that the dream all along, or was this just the path that you seemed to fall into?
Somebody told me that my initials RE is real estate, so I guess I was destined to do it. But no, I was a surfer. I mean, I opened up a surfing school before I went to work for Time, that was his name. I opened up a surfing school in the Dominican Republic, lived there for a year, almost never made it back. But then went to law school, and then when I started law school, my first year of law school, I told myself, I don't want to finish my law degree and have zero experience in business. Let's work for somebody while I'm in school and at least get some experience.
Yeah, absolutely. Do you surf still?
Yes, I do.
Good for you. Good for you.
Lately, mostly on the internet, though. But I take the family and kids. We go at least 3 times a year to a surfing trip.
Oh, that's cool. Good for you. Good for you. That's a skill I've never mastered, but it's one it's beautiful to watch when you know what you're doing. So
Never too late.
Never too late. I guess so. That's fantastic. Let's talk then really about 2 separate things here today. I know we kind of talked a little bit off air about how the office conversion, there's opportunity right now in office conversions. Can you give us some insight onto that?
Sure. I mean, I think everybody understands right now there's a lot of supply sitting out there, mostly of Class B office buildings. In a city like New York, where I'm in, right now, a lot of these buildings are sitting half empty. And some of them could potentially be converted. It's much easier said than done. Not every building can go through a conversion because you need the light and air and certain requirements, but definitely we're aware of at least 5 to 6 million square feet of office space in New York City that's being converted right now to resi. Most of them is being converted to rentals, which is good because the city needs rentals. And I think it's going to be the trend for the next 2 years probably, but not every owner, not every building can do it.
Yeah, that's it. That's really, really interesting. Yeah, I was speaking with someone here recently on the show. I think it was the last couple of weeks, and they were talking about the opportunity in office space, especially there in New York City right now. And they were saying they're picking up stuff maybe $300-400 a square foot, which maybe was trading, 3.5 years ago at $800-900 a square foot. Is that something similar to what you guys are seeing right now?
Yes, but again, it's mostly the Class Bs, right? And it's mostly on deals that have been slightly over leveraged, obviously. I mean, they're making a bet. Probably in 5 years, they look very smart with that bet. I think office will rebound. Right now, nobody wants to touch it. It's kind of like a four-letter world right now, right? Nobody wants to touch office, but I think that in 2 years, demand is back. You ask any CEO where he prefers to have his team, he'll say in the office. Right now, the job market is still strong, so employees can still kind of say, hey, yeah, I want 3 times a week and maybe twice from home, but that's going to end, and when it ends you'll see a rebound, but it's
Yeah.
not going to happen this year.
Right. No, completely understand. Yeah, there's nothing like the camaraderie of face-to-face meetings, and even with our kind of team distributed here in the Memphis region, it's and we don't get together face-to-face often enough. And I'm like, man, I just wish we had more face-to-face time. And I think that's probably, I'm not alone in that sentiment. But let's switch it around then and talk about the commercial lending environment. What you guys are seeing right now. You guys are lenders. I'm sure that things are shifting daily. So where are we right now?
Right now, most banks are on the sidelines and are not extending loans in general, maybe to specific clients that, very deep relationships. But in general, what we're seeing as a private lender, as a private debt fund, that we're providing now loans to top tier sponsors, operators on great assets that typically would be extended by a commercial bank. And we're doing those loans now, and there is a scarcity of senior debt out there. Now, there's a lot of capital for the B piece or the mezz, the risk piece, what we call, but there's scarcity of true senior lenders out there. So we're doing those loans, and we're very excited about it. But it's also, I would say, a bit scary because you look at the systemic risk; it definitely increased post the crash of SVB, Silicon Valley Bank, then Signature, lately First Republic, and everybody's asking themselves who's next, right?
Right.
So we're extending loans, but we're underwriting very carefully the basis, the sponsor, and for the most part, we're lending on residential because it's slightly easier to underwrite right now, resi, than it is other asset classes.
Right. And when you say residential, obviously, I think we're talking large commercial multifamily assets.
Correct. We lend on multifamily assets. We just gave $100 million loan on a hotel that's actually being converted to multifamily rental. It's going to be about 400 unit multifamily rental on near Columbus Circle in Manhattan. And we do a lot of also condo inventory loans. So we provide inventory loans to developers that recently finished or about to finish their condo project. And we're providing a loan against the unsold inventory.
Wow, that's really, really fascinating. I'd love to kind of dig into more of the mechanics of the private debt fund, how it works, what you guys are doing on the underwriting side, how that stuff has changed. Can you kind of just give us the high level overview of really just, I guess, the function of the debt fund, how you organize it, and then also maybe some underwriting criteria and how you guys are really protecting the fund?
Sure. So obviously, commercial bank, which is I wouldn't say the opposite of us, but they have deposits from clients, and they then extend loans based on their deposit base, right?
Right.
And the bank is essentially leveraging the deposit base 10-to-1, and it's highly regulated because it takes mom and pop and people's money, and then it extends business loans. I'm obviously generalizing. A private debt fund like ours is, we don't have deposits, we don't manage, mom and pop money. We have LPs, investors, institutions, and ultra high net worth that give us a commitment. So our fund is a closed-ended fund. It's on a commitment base. So we have investors that provided us commitments, and then we have the discretion where we deploy that capital. So it's less regulated than the bank. We have a little bit more freedom into making our decisions on what we want and don't want to do. And we're governed by our LPA, by our limited partnership agreement that says what we can and cannot do. Our fund, for example, is 70% focused in New York City. Everything else is in major gateway cities. And at least 80% of our loans are in first position senior secured loans, mostly on residential. So I'll just give you an example of a deal we did earlier this year. We gave a $313 million completion to condo inventory loan on 125 Greenwich. It's a super tall resi building downtown. It's about 88 stories. It's a project that got stalled during COVID, with all the construction delays and shutdowns. The prior owner ended up defaulting on its debt. A large company named Fortress Group, which manages 45 billion, ended up buying the debt, and after a long process, ended up becoming the owner. And we gave them a fresh new loan that will enable them to complete the project and then sell out the units. It's about 292 units. Our basis is slightly under 1,000 a foot. Those units should sell at around 2,000 a foot, maybe more. And we think it's a very interesting position to be in as a lender. We're at about half the basis of what we think the units will sell at.
Wow, that's fantastic. I love that. And I guess on the debt fund side of things, you guys obviously just raise all of that in equity. One of the things you'd mentioned there was that you have a commitment base. Do these funds function where it is you and I talk and I say, okay, Ron, I'll commit whatever it is, $1 million to the fund. And then when you're ready for the money, you guys call it? Or is it something where I say, I'm going to commit $1 million to the fund, and then I go ahead and just make that commitment and give the money right then and there? How does that work?
So it's on a drawdown basis. We basically call the capital as we deploy the fund. Now it depends when investors join the fund. If they joined when the fund was formed, then the initial capital call is small. If they joined in a subsequent capital raise when the fund is a bit more deployed, then sometimes you call almost 50% or more.
Right.
As soon as they join. It really depends how much the fund has deployed today. We're currently, just to give you a sense, we're over 80% deployed in our funds.
Got it.
Raising, we're probably going to raise the next fund during the summer.
Got it. What have been some things, I guess, that you've learned along the way in launching such a large, and obviously this has happened over at least a decade, if not more like 15 years, but what have been some things you've learned on the capital raise side of things, especially as it pertains to funds, that people should think about that maybe are just starting out and or maybe have a couple under their belt that you've done differently than maybe what you did at the beginning?
So I'll tell you two things that I've learned. And it started, again, we only started raising funds about 4 years ago. Before that, we were capitalizing on a deal by deal basis. And what I've learned is that if you have a good deal in your hands, the capital will be there. And a lot of time when people say I'm struggling with the capital raise, I don't have enough investors, the real answer is, well, the deal is not good enough, but it's hard to admit it, especially to yourself, right? And the other thing I learned about that is that it's easier to raise $100 million for a deal than it is to raise 10 million. There's just more capital, and it's kind of counterintuitive. A lot of people, when they start in the business, they start with small deals, obviously, because that's their capacity. And I found it's much easier to raise more capital to larger deals than it is to a smaller deal. And the last thing I'll say, and this is probably the most important thing, and you mentioned it when you said we had evolved during our life cycle. We started in distressed debt, then development, then income producing value add, then lending. And it happened because I keep asking myself, and I kind of, in the team, we keep saying the same, I tell them the same thing. We keep asking ourselves, does it make sense? Does what we do, does it make sense on a risk-adjusted return? And then when the answer is no, or maybe, then okay, what should we be doing? And in 2017, for example, for us, equity in New York City stopped making sense because of pricing, because of risks, because of regulation, and we started lending, and I'm very happy that we did, because it was, in hindsight, a very good decision.
That's brilliant.
We basically started selling everything we had. We had 2 very large office buildings in the city. We had almost 1.3 million square feet of office building that we owned, and we sold between 2018 to 2020.
Wow. That's cool. What are some of the terms maybe, and how have they changed here in 2023 versus what you guys were doing even maybe a year or so ago?
So I'll tell you what we're in our debt platform versus 2 years ago. We have lowered our LTVs, meaning 2 years ago we would be at 65% LTV. Now we're at about 55. And we actually increased the spreads. So because, if we gave a loan, I don't know, 2 years ago at SOFR plus 7, right? And SOFR was almost nothing,
right?
Or LIBOR. Now the same loan, SOFR plus 7, is almost 12.5%.
Right.
So the interest rates are higher, the LTVs are lower. We're giving loans to bigger and better sponsors on much higher quality assets. But, and I said it before, the systemic risk significantly increased. So, you have an environment where you're not sure where the takeout will be. If it's an asset that the borrower plans to sell, great. Hopefully he sells it. But if he's banking on a refinance, it's not really sure where the refinance is coming from.
Yeah, and that certainly gets risky. Has it been challenging to say no to previous lenders or previous borrowers, I guess I should say, as your underwriting criteria sounds like it has tightened? Has that been something where you've had to say to past clients, hey, I can't work with you anymore?
Two of the major reasons we pass on loans are either the proceeds asked for the proceeds is too high, or the interest rate is too low for us, for our capital. And that has been consistent. I think that's about 90% of the reasons we pass on deals is proceeds and rate. And we had a deal we passed on a year and a half ago, a sponsor we really liked that needed a $200+ million loan on an asset. We passed on it, somebody else did it. And then last week, we ended up giving an A note, meaning we took the senior tranche on that loan, 100 million. So it ended up coming back to us, but now in a place we felt comfortable in the exposure.
Right. Wow. That's a lot to keep up with, especially at those numbers, the magnitude, of a small mistake, just I would imagine, as becomes much more apparent. So that's really, really interesting the way that you guys handle this. Let's talk a little bit, maybe if you don't mind sharing with our listeners. One of the things obviously on the show here, it's called How to Scale Commercial Real Estate. And part of that is team. I think anybody who's found a way to build their business effectively has done it also with team. Can you talk to us a little bit about building out your company, team members, kind of how you have handled that strategically?
Well, it's extremely important. We've been focused on trying to bring into the company talent that we feel shares the same values, which is honesty, transparency, and, hardworking. You can't have success without the willingness to work hard. And I think selecting the right team members, and then, also departing from those that don't fit, the right chemistry and the right vibe is extremely important. And I think that, the culture we've developed is extremely open. We encourage anybody, even if it's your first day as a junior analyst, to speak up, to say what you think. If you think something doesn't make sense, it's not necessarily because you don't understand or you don't know. Maybe it just doesn't make sense. So raise your hand and say, I don't understand. It doesn't make sense. And I think that culture of being able to openly criticize the process, the deals, is extremely important and extremely valuable.
I think that's great. Yeah, and that's something that's the invaluable feedback. You can't buy that feedback, that willingness to have an open communication channels. That's fantastic. If you rewound the tape, maybe the past 10 years, and there was one thing you said a mistake that you could help our listeners avoid, what would it be?
Excellent. The biggest mistake, I think, for me in real estate, especially when you start out, is you try to force it. You try to force a deal. You need the deal to happen, because that's how you pay your bills and you get your fees and the upside. And a lot of time you have a deal lined up and you're doing everything you can for the deal to happen, which is good. But sometimes you cross the line and you push it and you try to force it, even though, again, you should be telling yourself, you know what, this deal, I might be better off just walking away from it. But you're already so engaged and you're so invested in it, and you're kind of trying to force it. And then that's where big mistakes happen.
Yeah, I can agree with that. That's certainly, I think, something all of us at some point, the desire to get a deal done. I think all of us are deal junkies in real estate to some extent. Otherwise we wouldn't be doing it. But that forcing a deal, that's a great piece of advice. Certainly appreciate that. Ran, it's been great having you here on the show today. I've learned so much from you, both from what your perspective is on the commercial lending side of things, how that's changing, how you guys are changing your underwriting metrics, your loan to values, the spreads that you guys are now requiring on those, how you're finding opportunity, your switch from equity to a debt position. You got a wealth of experience, and I certainly appreciate you taking the time to come on the show today and share that with us. If our listeners want to get in touch with you and or your company, what is the best way to do that?
Either on LinkedIn or directly emailing me. It's all available there. But LinkedIn is probably the easiest way to find me.
Perfect. And we'll make sure we include that there in the show notes, your LinkedIn. We'll find your LinkedIn profile and tag that in there. Ron, thank you again for coming on today. I do appreciate it.
Thank you, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.